Hello, traders. It's 8:01 a.m. Chicago time on Wednesday, the 4th of March, 2020. This is episode number 1705. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Just confirmed the third coronavirus case in New York. A student, I believe, that just came across a few seconds ago. We'll see how this thing keeps developing. Uh, I'm imagining dots on a map just appearing. Pretty scary thought. Anyway, the market this morning is has a slight risk allocation tilt to it. Yesterday, a surprise by the Fed that came in completely unexpected. At about 9 a.m. Central, 10 Eastern, the Fed announced a 50 basis point drop in the Fed funds rate, and the market just exploded to the upside, 90 points in the S&Ps, which is a fair amount for a just a 5-minute period. But then the market, I got to tell you, on the order flow on the way up, uh, past the initial push, I could see early on, and I commented on it. I could see early on that it's really having a hard time. That buyers were not really all that committed, and there was a good chance for it to turn over. In fact, on Twitter, I wrote a quick tweet about the potential that this thing may roll over, and as a result, I'm afraid it rolling over after a 50 basis point cut would mean that a lot more panic would ensue, as was what I anticipated, because if the Fed can cut 50 basis points and inject about 100 to 120 billion into the repo market overnight, and the market sells off, then what else can the Fed do to hold this thing up? I felt like that would be a huge blow to the Fed's arsenal if that happened. The market ended up selling off. It ended up coming back to 3057 in the S&Ps, which was the scene of the crime or the SOC or the place of the announcement, and it ended up taking it out and pushing farther. So from top to bottom, we had 164 points yesterday in the S&P, a record number of points, not a record by percent. Remember, comparing 164 points at 3,000 is very, very different than 164 points at, say, 600 or 700 back in the day when it was trading at those rates. So we still have the biggest move, the biggest range day in the S&P since 2007. I didn't go farther than that. Biggest range day was 15% of the then prices, which would be equivalent of something like 468 points in range at current prices. We have to think in percentages. Don't get caught up thinking in points, as prices are not the same up here as they were back there. Okay, so with that being said, the Dow is up 534 points. The pop higher is being attributed to Biden, who is the Democratic presidential, one of the Democratic presidential candidates. Biden taking the lead on Super Tuesday yesterday. The market is liking that. The market obviously now is pricing in a little bit of a doom and gloom with Bernie Sanders. As Bernie has been winning, the market has been moving down along with the coronavirus. With Biden taking, who's considered to be a moderate, an Obama moderate. I mean, he mentions Obama pretty much every speech. Um, he's considered to be more market friendly, so the market popped higher. This is what it's being attributed to. Who knows, to be honest with you, because finding the whys of what the market is doing is a pretty difficult thing to track, but it occurred at about the same time that this announcement came. Two candidates dropped out. A mayor out of Indiana, I believe, named Buttigieg, and a senator named Klobuchar have stepped out and have given their endorsement to Biden, giving him a boost. So that's where that stands. The market's liking that information. There are more and more cases being reported around the planet of coronavirus. We still don't have a cure for it or a vaccine or anything. So I think that's remains front and center. But the market's allocating to risk this morning with a Dow that is up 2.19% and crude taking a pop higher. There's a talk of a crude supply cut. Crude is up $1, trading at up 2.12%. The S&P is up 56.5 points from yesterday's settlement, 1.89%, and the Nasdaq's up 156.5 points from yesterday's settlement of 1.82%. Interestingly, gold is holding steady at 1642, down just $1.70, and you would expect that to come off. Gold, of course, responded very, very favorably yesterday to the Fed cut. On that announcement, gold popped higher by about 3% from the cash open, which is quite a move for that product. I mean, you would expect it. Gold is a hedge against the dollar. So that's where we stand this morning. I don't have much to discuss in terms of yesterday's trader bite. I'm not doing scenarios. There's no point doing scenarios when the highest time frame is in control and is pushing the market around. What's the point? But there was a lot that the market had to digest for yesterday, and overnight there were a lot of releases. I mean, Europe was chock full of releases. Uh, German retail sales, Italy's market services, France's market services, Germany's, as well as the Eurozone. Italy's GDP came out, Great Britain's market composite and services, Eurozone retail sales, France retail sales. I mean, it's just the list is endless. One of the more important releases was about an hour ago, which is the U.S. ADP employment change came in at 183,000 versus 175. If you recall, this is expected to be a proxy to the big number coming out this Friday, which is the non-farm payrolls in the U.S., the employment number. So ADP beat by a little bit, and that helps boost the market a little bit. Today, we do get the Bank of Canada interest rate decision. The prior is 1.7%. The market's pricing in a 25 basis point cut today. Also, there's just a lot of talk and rumors about a coordinated interest rate cut across multiple major central banks. The Fed just did its own thing yesterday, just came out and took care of its drop and may drop again. But if this thing gets worse, it looks like the central banks are likely to drop their rates. We do get crude oil inventories today. I'll let you look up your own calendar to find out the rest. There's no sense spending time on a calendar that everybody has access to. The other big thing to pay attention to today is at 10 o'clock, non-manufacturing ISM. That's likely to move us. And then we got the Fed's Beige Book at 2 p.m. Eastern. So 10 o'clock Eastern, 2 p.m. Eastern, both key numbers. And then the Eurozone has balance, not the Eurozone, Australia has balance of trade at 7:30 p.m. This is a time to be glued to your charts. It seems it doesn't mean you should be trading, but there's a lot going on, and we're seeing a very, very pure auction. The market really is scrambling to find value. So Let's take a look at what I was looking for yesterday. The only thing I'm going to cover here is I outlined some key areas to watch out for. This chart is squished. I mean, this chart has a range of 2,800 up to 3,500, 700 points. It's quite the range. But the key areas I was looking out for yesterday were the 3110 area. It went to 3137 on the news. And then beneath there, 3040 was really important. That presented some support temporarily. Beneath there, 3000. Beneath there, 2958.60. The low is around 72, I believe. Let's take a look. The low is 73. So in terms of what actually happened, here's what it looks like. I'm not going to spend too much time on this. Really, there's not much I can say here. The market did open just a couple of ticks, just a tick above the prior day's high, and was responsive. And the expectation yesterday, honestly, the big trade that I was anticipating yesterday was a push towards the 3040, which presents a low volume node from Monday's range. I was looking for a push there. I was going to wait for it, even if it pushes through. I was going to wait for it to push through. If it's going to push through, pay very, very close attention to the order flow to see how the prices are moving lower. And then I was looking for a long back to the high 39 3093, which is 50 points, and I was looking for it to consolidate and continue to 3120 and rest at 3120. That's what I was looking for yesterday. I was looking more bullish on a bullish bias yesterday, based on how we left things on Monday afternoon. There was quite a bit of buying on Monday, strong delta, strong pop. So I was expecting a higher high, higher low, and I was expecting the low to actually be in this 40 area. As I warned yesterday, there will likely be, I mean, I don't know how many times you guys were here, most of you probably. I don't know how many times I've warned shorts that yesterday was not likely to be their day. And we got this huge move by the Fed. I mean, you could hear stops going off before my quotes could keep up. So that short squeeze was very, very short lived before shorts came back in and pushed the market back down. But I have to tell you that I see some clean, clear structure across the board. I know many like to complain about volatility and stuff, but I'll show you one that I shared with the Convergent members yesterday. This is the NASDAQ 15-minute chart. I mean, as crazy as the NASDAQ is, I mean, you look at the NASDAQ yesterday had 500 points of range almost. 500 points. Huge. But look at the pullback. This is on a 15-minute. Look at this pullback. That pullback was to the tick, to the tick. I mean, pretty much, especially for a thin product. This low here is 87.05. This high here is 87.0450. So in terms of what I keep saying, in a market that has more volatility, we get a more pure, faster, tougher to trade, but much more pure auction. A lot of the noise steps out of the way. The market tends to test more completely or more obviously, and that's why I think being glued to our charts during these times is really important. At a minimum, we get to see what a market looks like. You know what it seems like? It seems for any of those that have done homework, and I always encourage this, playing back the market at high speed. If you play back the market at high speed, it becomes, I don't know what it's like for you, but for me, Playing back the market at high speed tends to allow me to see what it's trying to do much more easily, right? And what we have today with this volatility is a market that is playing forward in high speed, and it's a little bit more easy to see. That does not mean that it's easier to trade. At the end of the day, we still have to have wider stops, wider targets. We still have to have ironclad risk control. I mean, if you do not have your risk control in check, then just stop trading. Yesterday, this push down into the 40 went deeper than expected. It pushed to 23, I think. Let's see. Yeah, 2350. But you could see the structure again. As I said, I'm more of a price action trader than anything right now. You can see this playing out right here, this 40 playing out on the pullback. And what do we see? We see that the market yesterday puts in a low volume node right into the profile here, right where it put in the low volume node previously, right? Which was the area of a high volume node before that. We see that uh, commonly play out where we have prior acceptance, we get resistance. So, the market moved up to this naked point of control here. Again, look at how orderly the auction is and how respectful it is of the volume profile. It pulls back up to what was a naked point of control, this brown line, and comes right off and then breaks up above it, tests from above, and so on and so forth. This is what we would expect. This is why I like these kinds of markets, despite the fact that people are complaining about the volatility. Anyway, I'll leave you with that. I'll leave that to be. Here's what's happened overnight. We open up, everything's quiet until the Super Tuesday results start coming in, and then the market takes an upward skew. The volume has tapered off a little bit. If you remember yesterday, 868,000 contracts traded in the overnight session. And it's 648,000 in the current session, still quite high. There's about 4 times the volume on a price discovery. On an active price discovery profile, we have a P shape. This is a short squeeze indication here on yesterday's profile, which was in very, very active discovery mode. Very, very active discovery mode. We have what is basically a P-shaped profile. This is an early warning to shorts. Yet again, the S&P overnight is above its mid, above its VWAP, tangled up in the point of control. The point of control is in the upper quartile of the overnight range. This gives us plenty of fuel for a squeeze higher, and I'm looking for another push to 3,100. Can't draw a straight line on here with the mouse. 3,100 up here, and starts to challenge the string of singles that exist above this area up here in the 31, 12, 13 area. You can see that on the market profile very easily yesterday. So right here, the Fed announcement, and we get these single prints up here, and we're likely, if we push 3,100, we're likely to push through and challenge that Fed high. The market's kind of digesting that information. This is barring any further surprises or bad news on coronavirus and so on. The situation is quite fluid, and so we have to be as well as traders. Okay, let's look at the order flow on ctbookmap.pro. The order flow, interesting. The order flow is as noisy as it was yesterday. You could see those sprinkles everywhere. There's just sprinkles all over the place. It's really, really noisy. I have not changed my settings. It looks to me like there's just a lot of high frequency type of activity going on. A lot of bids and offers that are shifting in and out, but this market has collided pretty well with some liquidity overnight. Some liquidity overnight on the announcement. You can see that back here. The 3050 mid-century figure major strike price got collided with. We collided, pulled back, pushed through, consolidated, pulled back to the collision zone. Those of you who've watched my bookmap videos have seen this happen, and then we get the continuation. Remember, when I see an impulse, I'm looking to trade the continuation. Then we pull back through the 3050, and then have been consolidating here since. We do have a little bit of liquidity down at 3040. Remember, the 3040 is quite large in terms of significance in this area. And then above there, 3075, 3080. And then as we push into 3100, we get liquidity up there as well. So this is the full depth. My depth, of course, goes way, way out. But you can see what the key areas are, what the deep, deep liquidity, where that is. I expect and I suspect that we are likely to work our way through to that 3090, 3100 area, pushing into the open. Why? Because the market stance so far is for, the flow is easier to the upside this morning the way we are rigged. Now, look, I'm saying that knowing that the market can do whatever the hell it wants. It can drop. Participants may panic for whatever reason. It can do anything, but I have to look at what the posture is. The best analogy I have for this is if a person in front of you is giving you uh, aggressive looks and it looks mean and picks up their arm, makes a fist, and starts to pull their arm back. I don't need to be, I don't need to have some sort of an algorithm that tells me that I should probably duck or run um, or shift to the side or whatever. I know that what's likely, not guaranteed, they may make a fist and hold it in the air as a threat, but I'm likely to get punched in the face. And this is what we're doing here. We're kind of looking at things, knowing that, hey, the nature of this, the pattern of this is to continue in that direction, but it doesn't mean it'll throw a punch, right? We just get ready for it, and that's how it is. We're kind of, I've used the surfer analogy to death. We're kind of like boxers. We want to anticipate. We don't want to wait for the punch to hit our face to react. It's too late. That's what analysts do, and that's what pundits do after the fact. We want to make sure we can anticipate the movement and move out of the way or move in the direction of the force that's in control, and that's what this is all about. Good luck today, and I'll catch you tomorrow morning. Take care.